Hello. The company being analyzed today is Balu Forge Industries Limited. This company makes products and components used in railways, wind energy, and several other sectors. Today, we're going to analyze the company's financials, what the company actually does, and its future growth plans. So, let us start. First, we have a market cap of 5,095 crores. So, not the smallest of companies, not the largest, pretty small to mid capish. Okay, the edge of small to mid capish. Current price of one share is 443 rupees. Price to earnings ratio is 20.9 times. And book value, that is assets minus liabilities value per share. Book value per share is 110 rupees. Now, here we have the historical profit and loss of the company from fiscal year 2021 all the way to fiscal year 25. All these numbers and crores. First, we have sales, then we have operating profit, also known as EBITDA, profit before tax, and at the very bottom, we have profit after tax. And on first glance, you can see big growth. In fiscal year 2021, we have 142 crores of sales. Just the next year, it doubles. It doubles to 286 crores. Operating profit more than doubles from 12 crores to 37 crores. Then fiscal year 24, 560 crores of sales. And finally, fiscal year 2025, 924 crores of sales, 251 crores of EBITDA. You can see the big growth in EBITDA also. Okay, 254 crores of profit before tax, and finally, 204 crores of profit after tax. Here you can also see the big growth from 93 crores, 39 crores, again, you can see some pretty big growth. Then let us take a look at the cash flows. So here we have cash flows, pay attention to cash from operating activity, and you can see it's pretty volatile. 17 crores, then minus 58 crores, 26 crores, minus 32 crores, 148 crores fiscal year 25. So there's a positive, there's a negative. So they are volatile, but kind of a positive trend. 17, then 26, then 148, and the negatives are becoming less negative, minus 58, minus 32 crores. Let us see. So right now it seems to be trending in the correct direction, but let us see how it is in the future. Then we can take a look at these two things. First, net debt to equity. Net debt basically means total debt minus cash and cash equivalents. So you can see it went from 0.22 in fiscal year 2023 to minus 0.08, meaning net debt became negative. Hopefully, equity didn't become negative, but net debt becoming negative means cash and the bank balance is now more than total debt. So it became negative, then slightly negative, then 0.02 times. Okay. And we have return on capital employed, return on equity. So return on capital employed is a gray one. It was 30% in fiscal year 25. That is a really nice return on capital employed. Return on equity is the black line becoming, sorry, the red line becoming 25% for fiscal year 25. Again, that sounds pretty good. Here we have a summary of the balance sheet. Let us take a look at H1 fiscal year 26. That's the latest balance sheet in millions of rupees. So we have 4,364 million of property, plant, and equipment, or 436 crores. Okay. We have cash and bank balance of only 37.8 crores. Okay. A lot of inventory. This includes raw materials, I believe, finished goods also like available for sale. Then borrowings of 64.8 crores. And okay, cash of that much, borrowings of that much. No mention of investments. Interesting. Now, what does the company actually do? So, Balu Forge, leading with precision, machining, and engineering. Okay, that does not explain a lot. Okay, engineering, machining, and engineering. So, core product portfolio, crankshaft, railway wheels, brake components, hydraulic motors, lifting hooks, turbine blades, empty shells. Different products are there. Okay, these are some of the products. They're catering to aerospace sector, agriculture sector, automotive, defense, wind energy, railways. I can't see locomotives, marines, oil and gas. And there are two segments. There are two things here: machining, assembly, and forging. So basically, from what I understand, forging, you're taking metals into certain rough shapes. And machining is when you're taking those rough shapes into precision products. So metals are being converted into like defined shapes, certain shapes of products. For example, empty shells. certain shape. It's complicated to get that metal into that particular shape of an empty shell. Hydraulic motors, lifting hooks, turbine blades. You're making the metals and forging them and precisioning them into certain precision shapes. That made little sense. So forging 100,000 plus tons per annum of capacity. And look at this. They're increasing this to 1.5 lakh tons per annum. So forging 1 lakh tons right now capacity, they're increasing this to 1.5 lakh tons per annum. Then machining and assembly. This is the precision one, okay? Converting the rough materials into very precision shapes. So 22,000 tons per annum plus 58,000 tons per annum, that is around 80,000 tons per annum of that. And then we have the key products. You've already seen this. And you can see the number of industries they're catering to with their different products. And yes, I should have shown this. This is from Google AI. So they explain in simple terms, forging creates a rough shape with strength, and machining provides the perfect finish with precision. Balu Forge is unique because they do both in-house, taking a raw block of steel all the way to a finished engine part. Nice. Then there are different products. So here we have the auto components, non-auto components. We can divide the products into these two kind of segments. So auto components include crankshaft, undercarriage components. Okay, I can't see chassis components, front axle beams, control arms. Okay, steering knuckles, transmission and clutches, towing accessories, brake components. So you can see a different number of components for different parts of the car. Okay, so a diversity of components they can provide, a diversity of products. The non-auto components, they have railway wheels, turbine blades, lifting hooks, hydraulic motors, empty shells. I think this is for defense, oil, gas, and flow control equipments. So again, a diversity of the products is there. Then aerospace and defense. This is the newer growth trajectory. They've received approval to supply 180 plus products. And some of the products include, let's see, we got empty shells, again, empty shells, crankshaft, breech base, flanks. What's a flank? Clamps. Okay, clamps. You can see here, clamps. And first this. First this. The dedicated forging and machinery line for empty shells production, capacity 3.6 lakh shells per annum. So 3.6 lakh tons per annum, shells per annum capacity they have for empty shell production. And second, they're expanding into artillery, armored vehicles, ammunition, engine components. So artillery components, armored vehicle components, ammunition components, and engine components, again, the defense sector. So these are the approvals they've got, 180 plus products approvals for them, and 3.6 lakh shells per annum capacity for empty shells production. Okay, and this is a newer segment. Okay, newer. Then I think so it's newer. Then revenue contribution analysis. What product contributed what, you can say, or what segment? So here we have the different ones, and let us go for fiscal year 2025. So in fiscal year 2025, 40% of the revenue came from products catering to agriculture. 9% came from defense sector. 18% came from commercial vehicles. 18% came from commercial vehicles. Another 18% came from heavy engineering and industrial machinery sector. So components for the heavy engineering and industrial machinery, the machinery. And then we have two more segments, 10% from power generation components and 5% from oil and gas. So defense is already contributing 9%, and in first half of fiscal year 26 contributed 10%, in fiscal year 24 contributed 5%. So defense contribution is steadily rising. Then order book and revenue guidance. So the order book, I don't exactly have the exact amount of order book, which I probably should, but the current orders from customers, where are they getting it from? So in that, 35% of the current order book is for the defense products. This red one, 35%. Hold up, let me see this correctly. I think so, yes. According to my eyes, 35% of the current order book is from defense. Okay. So defense, depending on the timeline and how much time these orders are going to be executed, I guess different sectors may have different execution timelines, but still 35% is massive. 15% from agriculture, 20% from this grayer one, commercial vehicles. I hope, okay, yeah, commercial vehicles. Then 15% from oil and gas. Okay, even oil and gas, they're getting 15% of order book. See this one? Oil and gas, 15%. So, okay, defense and oil and gas, unexpectedly higher. Now, this is good. This is good. For fiscal year 26, Balu Forge will maintain the revenue growth guidance in the range of 40 to 45%. So for fiscal year 2026, they want to achieve revenue growth of 45% over fiscal year 2025. So we can take a look. We can go back here, fiscal year 25, 924 crores of revenue. So we can just add 40 to 45% into that. And yeah, that is what they're expecting. How much will that be? 924 plus 360 crores ish. Okay. Now, Balu Forge is also prioritizing high value segments like defense and aerospace, where expertise in advanced machining and heavy forging aligns well with the sector's stringent quality requirements. Okay, focusing more on higher value. So, defense and aerospace are higher value segments. One more insight we got. Okay, higher value. Then, through the adoption of real time monitoring, Balu Forge is optimizing its production processes to achieve improved EBITDA margins and sustainable financial performance. Okay, one more insight through what is that real time monitoring? Okay, they're optimizing, they're becoming more efficient in their production, and they want to achieve improved EBITDA margins. So they're definitely looking to at least maintain or improve their EBITDA margins through, again, efficiencies in what you can say production. Yes, production process. Then some quick facts. Look at this. More than 70% of revenue is generated through exports. More than 70% of revenues. It's an export led company. It serves 80 plus countries, has 4 manufacturing facilities, 25 original equipment manufacturer customers are served globally, and 500 plus is the workforce, 35 years plus experience in the industry. Then here, a dedicated 75% R&D team. And I want to show this. I don't know if I'm correct about this, but customer life cycle and long product journey is 15 to 20 years. So customer life cycle, basically the first moment the customer finds out about the product till the end time they're using the product, they're buying more and more product, and there's a connection with the brand, there's a connection with the producer. So it says 15 to 20 years. So I'm assuming that if they get a customer, they get a new customer, on average, based on historical facts, they're able to sell the customer products for 15 to 20 years on average. On average, they're able to sell customers the products, their products. It can be the same, it can be new, 15 to 20 years, which seems like a really, really good thing. Able to supply products to the same customers for such a long time. It's written here research to application takes 2 to 3 months, product development takes 3 to 5 months, and customer life cycle is 15 to 25 years. Then, okay, advanced and additive manufacturing, product engineering, and new product development. Okay, they'll be concentrating on making new and new products, of course, development of new materials. Project focus on exploring various new material chemistries to analyze compositions and applications of innovative metals. Okay, so they're looking, not saying this is going to translate to meaningful revenue, but they're looking into newer and newer materials, seeing if they can make new products with different materials, different from what they're using right now. Okay, Balu Forge Limited. They have seen some very nice growth in the past and looking for nice growth in fiscal year 2026. Uh, let's see if the cash flows improve. It's going to be interesting to see if they can actually grow the cash flows and continue to grow them in a positive trend. So that is it. Let us see how the company does in the future.